The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Thursday the 21st, 30 minutes to the close. What do you need to know out of Europe this hour? Well, to be honest, it's all about earnings. That's the main narrative that we're really focusing on. Unilever really front and center, I think, raising prices by 4%. That is the most in a decade. This as it pushes rising input costs onto consumers. The company's CEO basically saying that inflationary pressures will be around for at least another 12 months. That's worth thinking about. Barclays' quarterly profit more than doubling. The investment bank, which remember has been strongly backed by CEO Jez Staley, smashing it out of the park. We're going to hear from him this hour. And to the rate story, because rates are broadly higher, Turkey cutting interest rates by 2%, going against the grain, 200 basis points. This despite, of course, soaring inflation. The lira continues to fall. It's down circa 20%. Already this year. Let's talk about where we are with markets right now. What you've got are yields up, i.e. prices down in the bond market. The stock market fairly flat. One of the big drags, Alex, the resource sector, miners under real pressure here in Europe.
Yeah, and similar here in the U.S. as well. Freeport, for example, not meeting their production output goals for copper. So that idea, same thing with certain individual miners over there in the U.K. So overall, trading a little heavy, but it is definitely earnings here in the U.S. IBM had some issues last night when it reported its cloud services are doing well, but not well enough to offset slowing revenue from its traditional business. That shift taken a bit longer. WeWork nicely up from its IPO, right? It came out through SPAC at 10. Now it's 11.25. Finally going public. It's been like years in the making here. And I mentioned Freeport down by over 2%. And we also have yields rising higher, not as high as in the UK, up by 6-7 basis points. But here, the highest level for 5 years since 2020. I think January of 2020.
Yep. I want to take you back to a conversation, Alex, that we were talking about in the last hour with Portillo, depending on your pronunciation, from Chicago. The company IPOing today. I get priced at the top of the range 17 to 20. It's gone out at the door at 26. So some decent demand coming through from that stock. As it comes to market, it sees certainly huge opportunities in terms of its opportunity to expand across the United States. Let's talk about what is happening here in Europe in a little more detail. EU heads of state, they're in Brussels for a two-day summit. They're discussing ways to address the energy crisis. Soaring energy prices are exposing tensions, though, within the bloc. The German Chancellor, the outgoing Chancellor, Angela Merkel, very much addressing this challenge.
We need to clearly distinguish between the challenge we face in the fight for the climate. Fit for 55 is something different. This is about answering the question regarding what is leading to these spikes in energy prices.
We're joined now by our European correspondent, Maria Tadeo. She joins us from Brussels. They're not talking with one voice, but are we making progress in figuring out a way for Europe to deal with this problem? Energy prices are rising sharply and continue to do so.
Yes, Guy, and we've seen that pretty much in every week and week out to see those energy prices hitting a new record high. Now, when you look at the summit, it really is about the energy crisis that dominates the conversation here in Brussels today. But the question is how to fix it. And that's where divisions come into play. As you know, Guy, the energy market in Europe is incredibly complex and it's incredibly fragmented. There's countries that tend to use nuclear, others that goes or would go for gas. And that's the question, how do you bridge this transition into greener energy? Now, going into the summit, you remember very well that the French, but also the Spanish, had said that they wanted to see collective EU action, whether that meant renegotiating some of the big gas contracts as a single unit or perhaps, the storage of that gas to do it with joint procurement. That was something they put on the table. But today, the impression that we get is that this is probably not going to fly. In fact, Emmanuel Macron decided not to speak about this today as he made his way in, and the Spanish Prime Minister said that, well, ultimately, this is Brussels. Things take a long time to kind of manifest in the way that you would want them to. So again, when it comes to tomorrow and that day two of the summit, we're not really expecting any big solutions. And that is a big political headache for governments across Europe, who, as you know, are really trying to shield households from that increase in the wholesale price.
The idea eventually is that they could all kind of band together and have more pricing and bargaining power when it comes to wholesale buying of energy from the likes of, say, Russia. I find it really hard to see how 27 nations are going to do that, particularly when we have, changing of the guard over in Germany and then an election in France as well.
Yes, and Alex, what supporters of that idea argue is that when you look at the vaccine campaign in Europe, the fact that this was able to be done and get done as EU 27 in bulk actually brought down the price and was able to put the EU in a better negotiating position with some of the pharma companies. So they argue we should replicate this with the energy companies. The problem here, as you say, is that this energy market is incredibly fragmented. There's countries that are much more advanced on the renewable energy. There's others that are very much dependent on gas. When you look at Germany, they've spent a ton of money on that Nord Stream pipeline to still rely on gas. And then, of course, you have the French who say, if anything, we should be turning to nuclear. But that is a big political no-go in other countries. So, again, the issue here, perhaps well-intentioned, but the problem is how to execute a good idea. And joint procurement is actually or could be very hard and very problematic if you look at the different energy components that are made in every country. So, again, to see this happening tomorrow, I think that's very unlikely that we're going to see anything that looks like EU 27 procurement.
Totally. I agree with you on that one. All right, Maria, thanks a lot. Great reporting. Bloomberg's Maria Tadeo joining us from Brussels. So energy costs are just one of the challenges right now that businesses are facing, and it's adding to an inflationary environment that we haven't seen in decades. Now, Bloomberg spoke to the Unilever CEO following earnings.
Peak inflation will be in the first half of 2022, and it will moderate as we move towards the second half of 2022. So I think we're in for at least another 12 months of inflationary pressures. We are in a once in 2 decades inflationary environment, and therefore we have stepped up the level of pricing.
Well, joining us now for more is Freya Beamish, a TS Lombard head of macro research. Freya, is 12 months still considered transitory?
I think what we have to be really careful about here is to clearly define these terms like transitory and stagflation. And I think the stagflation element can be broken down into a sort of an appetizer of stagflation and a full-blown main course. And the reason why it's difficult is because we have more than one cycle running here at the same time. Now, what I'd call the appetizer is what we have right now. We have these energy crises. We have import prices rising very, very rapidly. And at the same time, we have growth starting to slow. And it's because we're in that part of the cycle which happens in every cycle, where growth is slowing and inflation is still high. But this is such an abnormal cycle. It's a very short cycle, which started with the shutdown in the economy and then the V-shaped recovery. And it's the amplitude of the cycle is massive. So it swamps everything else that's going on. And we now are in what I'd call like the cyclical stagflationary part of that cycle. But there's an underlying cycle, which is a much kind of more long-term thing. And the jury is very much still out as to whether that is going to be a more stagflationary cycle kind of going forward. So it's important to make these distinctions so that we're kind of clear about what we mean. And if I can give you a sort of the conclusions as to how we see it, we actually think this stagflation appetizer will go on, and we'll continue to see these supply side shocks because the economy is just less able to respond. Yep. The supply side is just less able to respond. And that will cause a lot of volatility for markets. It's difficult for markets to understand. But there's this gravitational deflationary force that starts to exert itself in the second half of next year before you get the question on the main course of stagflation being opened up in the longer term.
This whole show is about food. It seems to be kind of eating into everything, to excuse the pun. Freya, okay, you talk about the volatility that's going to be generated from this. What is the message that you would give to investors as a result of what you're describing?
So there's a lot of volatility, but there's actually, because of these deflationary forces and the kind of the disinflation that we're seeing, by the end of next year, I think the direction of markets is going to be defined by these these deflationary forces. So to stop being elliptical about it, I mean China's slowdown and the depreciation of the renminbi, and that actually opens up bonds as a portfolio hedge again. So that at least gives a kind of a silver lining to what is a very difficult market environment to navigate. But at the moment, we still very much are in that kind of quadrant of this bizarre cycle in which stagflation is dominating, and it's hard to know exactly where to put your money.
Freya, if we're in the stagflation appetizer and central banks are taking that opportunity to pare back stimulus, we'll leave the PBOC out for a second, and the ECB, I guess, what does that do?
So the whole new monetary fiscal framework that is starting to be established since the COVID crisis, or that has really been accelerated since the COVID crisis, that's vital for answering the longer term question on the main cause of stagflation. But in the meantime, the deflationary forces that I think are coming online from China's slowdown and sort of the ending of a chapter of Chinese growth and therefore global growth, that actually starts to take the edge off this hawkish tone that we've heard coming through from the Fed since really Jackson Hole, when they started to wobble a little bit on AIT. And that starts to push them back onto needing to stick to the AIT guns and be slightly less hawkish about things. So you have to take a very global view of it, and I think those narratives will come in quick succession. But certainly we're less worried about kind of term premia continuing to rise in the second half of next year than we are at the moment.
Any of this going to cause a major stock market correction?
Well, I think at the moment we still are in the volatility stage, but to be honest, like China is shifting to a completely new structural paradigm. The property market there is broken, and it's a completely different structural growth pattern that we're going to have going forward. It's the end of an era in China, and that seems like it's something that we can put in a China box and put it over there. But actually, it's going to impact on commodities. So first of all, it will come through to miners, and then it's going to impact on luxury. It's going to impact on autos. These guys all have very high earnings in China, and we know that the stock market is not the economy. So even developed markets are going to have this impact coming through from China. So I think, yes, a correction is coming. The timing, I would say we'd have to go into the China story in a lot more detail to get the precise timing on that. So maybe we go to that later.
Funny you should say that. Let's hold that thought. We will come back. We will carry on the conversation, and we will get more granular on what is happening in China. Freya Beamish, TS Lombard, is going to stay with us. We'll carry on the conversation around China. We need to talk about Evergrande, of course, and what is happening there. The broader housing market, I think, is extremely relevant to this narrative. We've also got a press conference taking place. Nancy Pelosi, the House Speaker, is talking about various things, but she is talking about the fact that we are seeing a narrowing of possibilities, Alex, for the economic agenda. Progress is being made. Great progress, she says, is being made. She says that that Kirsten Sinema's position is, quote, well known. Maybe it's well known to everybody else. My question is it well known to Kirsten Sinema?
No, based on what we know, probably not. Also, I want to update you on NOAA. So that's basically the weather report for the winter that comes out, and we want to widely follow it because it's going to have direct impact in terms of natural gas and heating demand here in the U.S., which will then also affect what we can ship out to the likes of Europe and the UK. So NOAA is saying that they expect below average temperatures in Alaska and the Pacific Northwest, and above average temperatures in South this winter, plus wet conditions great across northern U.S. So basically you got wetness in the Northeast, and everywhere else is going to be above average temperature. So maybe it won't be that bad, Guy? I don't know.
But I'm assuming that's just North America. They're not making a prediction for over here.
It's just the U.S., just the U.S.
You guys look okay. So it's going to be a bit colder up north, but basically mild and wet everywhere else, which is something that I'm very familiar with. That sounds okay. That sounds like a manageable situation. I think what everybody's worried about is this kind of really cold northern hemisphere winter, which that doesn't sound like we're quite there yet, because obviously that's going to impact Russia. That's going to therefore, by extension, then impact Europe. That's going to be the challenge here.
Yeah, so maybe we won't be so naturally gassed and power challenged. So that's the latest from NOAA. This is Bloomberg. So let's get back to China here. You got shares of the troubled property giant Evergrande falling as much as 14%, resuming trading following a 3-week halt. Here with more is Damien Sassower of Bloomberg Intelligence. Damien, there was going to be a lifeline in selling a stake in something. It doesn't seem like they're going to be one anymore. Where are we here?
That's exactly right. So the next 36 hours are going to be pretty revealing for the China property sector, beginning with Evergrande. They did have a deal in place with Hobson. That deal fell through for $2.6 billion. It would have gone a long way to allowing the company to not default on the $83 million coupon payment, which is the 30-day grace period expires this weekend. So we're going to know a lot about Evergrande come this weekend. And then shifting to Kaisa, the third largest issuer of China property debt, hard currency China property debt. Kaisa basically has a $36 million coupon due tomorrow, and we're going to find out whether or not they make payments on that, and all indications point to the fact that they may not. So the next 36 hours is going to be very revealing for China property for sure.
Absolutely. The question is, does this become a systemic problem? Damien, thank you very much indeed. Damien Sassower of Bloomberg Intelligence. Let's get back to Freya Beamish from TS Lombard. Freya, there was a quote that really stuck out from a good friend and colleague of mine, Mark Cudmore, who wrote a piece this morning. Real estate sales plunged around 97% during the peak home buying season recently. He says that China can survive Evergrande's collapse. Its economy and the global markets will both be decimated if there is a systemic property market correction in China. What is the likelihood of that happening?
So we're monitoring these data very on the high frequency data that we can scrape from Baidu and from pretty much anywhere we can, because it is such an important question. And I think essentially the property market model that has been in place for decades in China is now broken. And that is a massive statement. It's hard to just explain exactly how big that is, but it gives us, Evergrande is sort of the canary in the coal mine that is telling us that a chapter of growth of economic history in China is ending. The kind of the old guard polluting, debt-ridden model in China is ending, and we're moving into hopefully a greener outlook. But the question still remains on the debt side of things, and that's maybe a question we should set aside for kind of a more longer outlook. But in the meantime, that previous chapter is going to have a very serious sting in the tail for the next 12 months. So, and essentially, to put it in a nutshell, the Chinese policy put is no longer effective in the way that it has been in the past kind of mini cycles that we've had over the financial crisis.
Freya, markets don't seem to care. Like, I don't see any contagion, even if there may be a PBOC cut, for example, to help. Why do you think that is? And should there be a bigger reaction of contagion?
Yeah, there was a lot of reaction initially, and it all now seems to have died down to the stagflation story. And I think that's natural in a way, because I think markets are still putting a lot of faith in the Chinese policy put. But I think that faith is misplaced because the Chinese policy put actually was breaking down before COVID, but the evidence of that had actually been completely knocked out by the severity of the COVID cycle. And now we have a situation where China has been actually tightening since May of last year. They've instigated the 3 red lines in November. Credit growth has slowed very dramatically over the course of this year, so has M1 growth. That's an indicator that the Chinese economy is slowing very rapidly at the moment. We're already seeing that coming through in the data. It's an indicator that global growth is probably already slowing. And the point now is that markets probably are relying on this put coming through. And about halfway through next year, we're going to realize that money and credit growth aggregates are not picking up. And then further into next year, we're going to realize the real economy is not picking up.
What does that mean for Europe? Europe relies on Russia for energy, China for exports. What does this scenario look like for European growth?
So it's this combination of a lot of volatility caused by the kind of the stagflationary appetizer that we were talking about before. But I think the gravitational pull is by China, because as I said, this is This is the ending of an era for China, and it's a cyclical slowdown that has to take us to a completely new structural environment. And that probably dominates in terms of the direction of markets. And then you get a lot of volatility that's caused by the supply side disruptions, which are ongoing. But again, it opens up bonds as a portfolio hedge.
Freya, really great to get your perspective. Enjoyed the conversation. Freya Beamish of TS Lombard. Thank you very much. All right, coming up, we got Turkey cutting rates yet again. The lira weakening against the dollar yet again as the central banks move. More on that next. This is Bloomberg. Well, Turkey's central bank chief delivering a bigger than expected interest rate cut despite soaring inflation. The lira now weakening 20% against the dollar so far this year. I want to bring in Bloomberg's Simin Demirkan, who joins us from Istanbul. Rising inflation and a rate cut. That doesn't make sense.
Well, it's no secret that Turkish President Recep Tayyip Erdogan hates high inflation. And for the past few months, he's been pressuring the Turkish Central Bank to cut rates. And that's exactly what they did today. They exceeded all expectations and cut by 200 basis points, bringing the benchmark rate to 16%, while the annual headline inflation is just shy of 20%. President Erdogan has this unorthodox theory that high rates actually spur inflation. Of course, if you were to ask most economists around the world, they would disagree with that view. So today, the lira, as you said, continues hitting record lows against the dollar. It's right now the worst performer in emerging market currencies so far this year, depreciating some 21% against the dollar. And it's on track for its 9th year of losses. Economists we've been speaking to say the lira could weaken further as we're expecting more rate cuts over the next few months. Now, of course, President Erdogan is facing political pressure as well. His popularity in opinion polls is falling, and this is mainly to do with his handling of the economy. We have high inflation and high unemployment. And of course, the opposition parties are also proving a threat.
Simin, great stuff. Thank you very much indeed for the update. Simin Demirkan joining us from Istanbul. Does make you wonder how much more of this the population is going to take. What I got for you next, we're going to look at Barclays' results. They absolutely knocked it out of the park at the IB. We'll talk about that. That's coming up. We'll deal with the market close. Unilever's stock on the move as well. There's lots coming up. This is Bloomberg. So wrapping up the Thursday session here in Europe. We'll go through the auction process. We'll see the final numbers a little bit later on. But this is where we are as we come into half past. You are looking at a softer story. It's not down by much, though. So it's a kind of a sort of story of maybe half of 1% in London. The CAC 40's down by a third. The DAX is down by a third. The FTSE MIB in Milan is down by 0.2%. There's not a lot of downside move here. It's really about the earnings narrative, I think. I appreciate there's a big kind of macro overlay. Rates are going higher, and that is certainly a force that you've got to kind of pay attention to. But earnings seem to be the narrative that we're really looking at. Stock 600, the session looks a little bit like this. Again, reasonably tight range. We saw it yesterday. It's a very similar story at the moment. Reasonably evenly balanced. A little bit of a climb at the beginning after a gap, and then basically just sideways trading, coming back up to almost unchanged on the session as we come through the day. So we're just sub 470 right now. Still near, very near record highs here in Europe. The sector breakdown is interesting and again is largely controlled by the earnings narrative, I think. We are seeing the car sector doing relatively well, the financial services sector is doing well, some of the food stocks are doing well, the luxury sector is coming back. Bottom end of the market, basic resources, that's Anglo. You've seen some of the US miners as well coming under a little bit of pressure. Freeport-McMoRan certainly front and center over there. The energy sector's off a little bit as well. But within that kind of mix, I think actually it's worth focusing more on the single stocks rather than the sector narrative. So let's talk about that right now. Unilever up by 1.2%. Alain Job walking us through the numbers this morning. The real standout story, though, amongst those numbers was what they're doing on pricing. They are pushing the input costs straight out the front door to consumers. They're raising prices by around 4%. He thinks that that's going to continue for at least another year. But they are making the price. They are able to pass that on. This is a company do you really want to pay attention to in terms of what it's doing? Because it is going to have a bigger impact and it is going to continue to be able to do this. That certainly is the message that is coming out of the company. But it's an interesting narrative. Then you take a look at what is happening with the banks. You've got Barclays tracking down. It's down by around 0.6%. But generally, actually, what you saw today was a vindication, Alex, of Jez Staley's strategy. He's had a firm focus on the investment bank. That investment bank continues to deliver.
It does. Somehow yet not good enough. There's still some clouds that some analysts point to as well. Well, Jez Staley, Barclays CEO, spoke to Bloomberg after those results.
Overall, the investment bank had a very solid quarter. In investment banking fees, on the primary side, whether it's advisory, debt capital markets, equity capital markets, we had the highest quarter in the history of Barclays. And in the markets business, they continued with very strong profitability. And you'll have mixes between FICC and equities and in other parts of the business. But overall, we were very pleased. You know, we delivered a record £7 billion year to date. Barclays has never been this profitable and never been this well capitalized. And the markets business has done its part.
Well, joining us now from more, Vahid Kunwar, a Redburn bank analyst, joins us now. He's a buy rating on Barclays. Okay, so the investment bank we know was really, really good. Some analysts are pointing to things like they didn't release any money for credit provisions. The consumer card business wasn't that great. What was your overall takeaway?
Yeah, look, I think the investment bank was a standout performance, of course, but the market's very quick to look through that. And we've been here before. 2009 was one of the best years for investment banking in history. And the next kind of 5 or 6 years were a constant drudge downward. So the market tends to assign a very low multiple on investment banking beats. Why are the shares down today? The kind of forecastable revenues, the NII in the UK business, and particularly the credit card business in the US were soft. So credit card revenues were 4% miss versus consensus. And it looks like actually what we're seeing here is while consumer spending is back to pre-pandemic levels, people are paying down their credit cards faster than you would expect. So the actual net interest income growth from credit cards isn't coming through. And that really has offset the CIB beat and is why I think the shares are, performing. They're I think they're flat right now. Actually, they're down 60 bits today. They're flat at the moment. So the market's kind of seen this as a kind of not a lot going on. The CIB upgrades come through, offset by CC&D. And the overall question now is all the rate noise you've had in the last year on the banking sector, can you actually see the money coming through? And that's the big question, which really wasn't answered by Barclays.
So what is your perspective on that? We are, according to the Bank of England, going to see rates going high. The market is pricing in an aggressive rate cycle, maybe slightly overdoing it. What impact, if that were to be fully fulfilled, i.e. what the market is pricing now, was to come into existence here in the UK, what impact would that have on Barclays?
Well, today Barclays said that a 25 bit rate rise, they were previously thinking would be a £150 million benefit. They now think it would be more like a £275 million benefit because their ability to put mortgage rates up or put the asset rates up and not pass all of that through to depositors in the first rate rise is more than they thought. So the actual benefit from rising rates they talked about today was higher than we expected, and that has been offset by the kind of lower credit card revenues. But I think before this call here, someone was talking a lot about stagflation, and that's the issue now. I think a few months ago that all rate rises are very positive by the banks, but the banks are up almost 40% year to date. The question that's now coming more and more into focus is what are the difference between good rate rises and bad rate rises. And that stagflation narrative really is now starting to dominate the banks a little bit. So on the surface of it, Barclays will make more from higher rates. But the question is, are rates going up for good reasons or are they going up to out of control inflation?
So is that why we didn't see any release of credit provisions? Like, do you get the feeling that Barclays is sort of prepping for the bad rate hikes?
I mean, they said it explicitly, actually, not the bad rate hikes, but essentially, as it stands right now, their biggest risks on the credit card book. In the UK, the furlough schemes have only just rolled off. there are still support mechanisms in place in the US. And I think until those support mechanisms roll off, until they see how the inflation narrative plays through, they're very careful on releasing the significant provisions they have on both the US and UK credit card books. And I think that is what is driving the caution in terms of reserve releases.
What is the read across into NatWest? What is the read across into Lloyd's? What can we learn today that is useful in terms of what we can expect there?
I think on the positive side, we can expect the banks now to actually try to capture more of the rate rise into their income than we thought previously, because what they'll try to do is not pass it on to depositors. And that's what Barclays changed in their assumptions today. So that's a positive. I think what we need to see, though, is upgrades. The point was made earlier that we are now in kind of show me the money earnings territory. And at the moment, I think Barclays delivered that on the CIB, but it's a low PE business. But Lloyd's and NatWest now, given how strong the shares have been in the last 6 months, we need these banks to deliver net interest income beats and actually convert this higher yield story into genuine earnings. I don't know if management will be able to give much color on loan losses. Loan losses remain very benign. Over the next couple of quarters, we will see how the economy is shaking up because growth is slowing and inflation is rising. I think that is starting to weigh on stocks that have done very, very well.
Fahad, it was really great to catch up. Thanks for the analysis. We really appreciate it. Fahad Kunwar, Redburn's bank analyst. Greatly appreciated. Let's just check where European markets have wrapped up. As I say, a mildly negative session. And we see that continued through into the close, as you can see. FTSE 100 just below the 7,200 level, just breaking that today, down by 0.3%. The mining stocks, the real drag there. But on the continent, the DAX a little lower, the CAC down by 0.2%. But it's an earnings narrative. It's a bottom-up rather than a top-down narrative, I think, today, Alex.
Yeah, and we're going to stay with that narrative right now because you got the largest car dealer chain right here in the U.S. had a very strong quarter because of the surge in used car sales. You got Mike Jackson, AutoNation CEO, will be joining us next. That stock up a whopping 7% today on a softer tape. This is Bloomberg.
This is Bloomberg Markets European Close. I'm John Hyland, live in the principal room. Coming up, Union Pacific Chairman and CEO Lance Fritz. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
Live from New York, I'm Alex Steele with Guy Johnson over in London. This is the European Close on Bloomberg Markets. All right, so you got Mike Jackson is going out with a very big bang as the AutoNation CEO, as he's retiring on a string of 6 record quarters after 22 years at the helm. Bloomberg's Abigail Doolittle is looking at some of their results. The stock up a solid 7%.
It is, Alex. A big bang to go out for from CEO Mike Jackson. Really stunning results here. They beat bottom line and top line in a big, big way. Bottom line putting up more than $5 per share in adjusted earnings. And that is the 6th record profit, as you just mentioned. Take a look at this chart. This tells the story. Really incredible numbers put up here by AutoNation, and the pandemic helping out in a big way. Initially, there was the demand for used cars surging, and then the chip shortage. You put that together, surging used car demand. Now, if we can put this together in a graph here, take a look at this. In September 2020, you can see AutoNation's used car inventory, 56,000 cars. September 2021, 5,000. That is the shortage. That translates into great pricing. And in fact, if we break down new cars next to the old car sales, it's a very, very strong picture overall. You're going to see here for new cars, while the sales are relatively flat, very, very profitable because of those price increases, whereas the used cars, the sales just surging. You put it together, a record car, it's a record quarter. I'm so excited about this because it was so fun to read about, and I followed CEO Mike Jackson through the years. A great way to go out for sure. Stunning, stunning results here, Guy.
Stocks up 7%. Is this as good as it gets? Abigail, thank you very much indeed. Well, Mike joins us now, the CEO of AutoNation. Mike, let me ask you that question. You're going out with a bang, as Abby says. Is this as good as it gets?
All right, look, so we had an 18% increase in revenue to $6.4 billion. And when production was disrupted with this god-awful, unbearable pandemic and now the chip shortage, we as a company felt that we could offer our customers nearly new pre-owned and went into the marketplace and bought everything we could get our hands on. And with our brand and our customer experience and one price, we've driven pre-owned sales through the roof, far outperforming the industry and our peers. So a very smart move and certainly capabilities that AutoNation have. So pre-owned revenue was up 53% in the quarter, just to give you some idea.
Well,
we've taken appropriate pricing steps on new cars, considering the shortages. And we've been very optimistic and bullish about AutoNation as a company, as automotive as a sector. And we repurchased 11% of the outstanding shares just in the third quarter. If I look over the past year, we repurchased 27% of the outstanding shares. You put it all together and you get a 115% increase in earnings per share.
So, Mike.
And a new all-time record.
Mike, I feel like you're proving
Yes.
Guy's point. Is this as good as it gets? Because at some point, there's just not going to be that kind of upside for used cars if the chip shortage winds up shaking out, which some say will happen in the back half of 2022. So is this the top?
No, I would not say that at all for AutoNation as a company. You know, there's two different questions if you're asking about the industry or you're asking about AutoNation. So AutoNation has a unique, outstanding performance here because we've built a brand that spans America, and we have a digital platform, and we're growing organically with the building of our AutoNation USA stores, and we opened up 2 more in the quarter, and we have 12 more that we're building next year. So we're organically growing our footprint. We're taking here's the point, we're taking significant share in pre-owned, and I don't see that stopping. We're going to continue to do it. We have the brand, we have the capability to acquire the vehicles, so there's nothing that's not sustainable about that.
Mike, customers are paying sticker, which must be a bit of a shock to them. And I'm wondering whether or not long-term this is going to change behavior. Discounting has gone out of the window. Do you think we're moving into a new paradigm in the way that cars are priced and people buy them?
I would give you 2 insights here. One, I have always advocated within the industry the point of view that the production push liquidation system that's run by many manufacturers here in the United States is ruinous to the industry, and there's a better way to do it. And there was a lot of change after the bankruptcies in 08, 09, a more enlightened approach. And with this god-awful pandemic, I think there are more lessons learned that not overproducing is not only good for the manufacturers, suppliers, and retailer, but also good for the customers because you're protecting the value of the vehicles that are already on the roads of America, which total 275 million. So the consumers in America are delighted with the value of their vehicle. And they're more looking at the difference between what their vehicle's worth and what they're buying. So that's why when you talk about inflation in auto and pricing, that's not how the consumer is looking at it. So I think there are deeply learned lessons here. And when production is able to resume to somewhat more close to trend, the other thing we're doing is selling vehicles on an incoming basis, and they come in and go out. So I think the huge inventories of the past are indeed in the past.
Mike, that's interesting because that feels counterintuitive to the narrative that we hear a lot about, which is the just-in-time inventory world is what's out, and we're going to see broader inventory builds. Do you feel for now
those can both be true? So I think on the production side, just-in-time inventory arriving at plants where a plant can be shut down because there's a hiccup somewhere in Southeast Asia, I think that is definitely being rethought. As far as the consumer, though, now listen, it's a bit extreme at the moment, so I'm saying the truth is somewhere in between production push and what we have at the moment, that there is a better way forward.
Mike, do you think higher rates are going to change consumer behavior? Do you think that if they are having to pay higher rates on their credit cards, for their cars, and everything else, we're going to see a change in behavior? Do you think higher gasoline prices are going to change behavior?
All right, two things. I don't think we're anywhere near high interest rates. Now imagine, I've been in business 50 years. So now maybe higher is a correct word, but not high interest rates. Rates, rates are incredibly low. Listen, I've been in this business when rates were 18, 19, 20%. So I've seen it all. So, okay, there may be higher interest rates, but if you put it in historical terms, they're extremely attractive, particularly for a product that needs to be financed like automotive. Now, as far as gasoline prices, compared to, let's say, a decade ago, the fuel economy of vehicles in the United States, and particularly SUVs and trucks, has been dramatically improved. So the cost to drive a mile and consume gasoline has gone down tremendously. So I would say, look, nobody's happier. Nobody in America is happy about higher gasoline prices. The attitude in America is the Lord bequeathed cheap gasoline to America. That's sort of the mindset of the consumer. So nobody's happy about it. But the freak-out price, where you really change consumer behavior, is somewhere above $5 a gallon as a national average.
So we're just definitely not at all
We're far from
there
that.
yet, Mike. So before we let you go, this is your last earnings call, last earnings interview. You're going to be retiring. Where are you going on vacation first?
I'm going to stay right here in the good old America. Listen, I got more miles. I got millions of miles around the world. I love the world, but I love America the most. So I'm here in Miami. The season's about to start, and I'm going to enjoy it, and then ease into some travel.
Well, Mike, we really appreciate your time. It's always been fun to talk to you about the industry, and we look forward to chatting with your successor as well, Mike Jackson, AutoNation CEO. Thanks very much. And stay with the supply chain conversation. Later today, there'll be a special edition of Bloomberg Markets, The Close and What'd You Miss, focused on supply chain pain. Caroline Hyde, Romaine Bostic will be live from the port of Long Beach at 2 p.m. in New York, 7 p.m. in London. Don't miss that. This is Bloomberg. Live from New York, I'm Alex Steele with Guy Johnson over in London. This is the European Close on Bloomberg Markets. All right, stuff happening in the next 24 hours. President Biden is participating in a town hall in Baltimore trying to sell his economic plan. But Guy, as Anne Marie pointed out earlier in the last hour, he doesn't need to sell it to constituents. He needs to sell it to Congress, his own party first.
Yeah, Joe Manchin and Kristen Sinema, I seem to be holding this whole thing up. Taxes, everything else firmly in focus, but it does seem as if managing those two and the relationship with the party is the major challenge right now. Maybe you should stay in D.C.
Yeah, maybe.
What else
we got Intel later on, by the way, looking for those third quarter earnings. It's all going to be that global chip shortage. So that's going to be fun. Like, that read-through will be very informative today.
Absolutely. You want to pay attention to these calls, particularly those companies with exposure to the supply chains. Emmanuel Macron telling EU leaders within the last few minutes that the energy price spike that we're seeing at the moment will be prolonged. They meet again tomorrow. Whether or not they're going to be able to thrash anything out in Brussels, these EU leaders, in terms of a common policy towards energy remains to be seen. We get manufacturing PMI data across Europe. That's going to be fascinating. What impact are these supply chain shortages having there? We've talked about the China slowdown today. We've also got a Russian rate decision, Alex, coming up. Today it was Turkey. Counterintuitively, the rate cut. Tomorrow, we're expecting a rate hike out of Russia.
Yeah. Talk about the central bank divergence. I feel like that's going to really pick up, particularly if the PBOC is going to go more of the way of the Bank of Turkey at the end of the day and have to kind of ease conditions because of what's happening there in the property sector. Here in the U.S., it is very much focused on that earnings sector. It's a tough tape, but you have consumer discretionary leading the way. Under Armour doing really well. On the downside, you have, say, Freeport-McMoRan after missing production targets. Yields, though, here, Guy, very much pushing higher. Inflation expectations for the 5-year at the highest levels since the early 2000s. And then you have the highest level on the 5-year absolute yield, the highest since February of last year.
Yeah, you got to pay attention to what is happening with the rate story. You got to pay attention to what's happening with the earnings story. You got to beat and raise, it seems, to be able to make progress in this market.
Or just not go down at the end of the day. All right, they're upset for me and Guy on television. Coming up, you got U.S. Senator Joe Lieberman will be joining Balance of Power with David Weston on Bloomberg Television and Radio. And Guy and I, speaking of, are going to the cable on Bloomberg DAB Digital Radio. This is Bloomberg.